Magna International Inc., stock ticker MGA, is a multinational mobility solutions and technology company for automakers that designs, develops, and manufactures automotive systems, assemblies, modules, and components. Founded in 1957, Magna is now a $17 billion by market cap manufacturing monster that employs more than 170,000 people. Fiscal year 2022 revenue can be broken down by product category: body exteriors and structures 42%, power and vision 31%, seating systems 14%, and complete vehicles and other 13%. Based out of Canada, Magna is one of the world's largest manufacturers of OEM components for various automakers. Magna is large, yes, but it's also quite broad. Magna is so broad, it could almost be its own car maker. Morningstar sheds some light on this, and I quote, "Many suppliers focus on a particular area of the vehicle. In sharp contrast, Magna's capabilities are so broad that the firm could nearly design, develop, supply, and assemble vehicles all on its own." Unquote. We know two things about mobility. It's becoming more pervasive and it's becoming more complex. Companies that are already in the industry are expanding their EV and self-driving efforts, while many competitors in waiting are trying to jump in. Simultaneously, and related to that first point, vehicles are becoming increasingly complex and technological. This clearly bodes well for Magna. Any company that's trying to quickly scale up in mobility is naturally going to consider partnering with a capable manufacturer. And the more complex vehicles become, the more important it is for the manufacturer to be technologically adept. Magna is arguably the most capable and adept manufacturer of all. The world is seemingly demanding more mobility and tech. In a world that demands more complex mobility, Magna's revenue, profit, and dividend should continue to grow for years to come. Thus far, Magna has increased its dividend for 14 consecutive years. The 10-year dividend growth rate for Magna is 12.6%, which is strong, although more recent dividend raises have been in the mid-single-digit range. Not surprising to see some lumpiness here, as the auto industry was directly and severely impacted by the pandemic and related shutdowns. But I think Magna's commitment to the dividend during this period, in spite of unprecedented manufacturing interruptions, speaks volumes. With the stock yielding 3.1%, investors are getting paid to wait until the industry recovers and fully normalizes. This market-beating yield, by the way, is 30 basis points higher than its own 5-year average. And this dividend is protected by a payout ratio of 42.3% based on trailing 12 months adjusted EPS. Really balanced dividend metrics here. You get a solid dividend that's safe and growing at an appreciable clip. Looking at business growth, Magna moved its revenue up from $34.8 billion in fiscal year 2013 to $37.8 billion in fiscal year 2022. That's a compound annual growth rate of 0.9%. Definitely not encouraging. However, as I touched on earlier, the last few years have been extremely tough and unusual. And this hasn't been the fault of Magna, nor has it been a sign of poor business performance. Rather, external circumstances impacted the entire industry. Magna is still trying to get back to peak fiscal year 2018 revenue, which was nearly $41 billion, which I think they'll get to within the next year or two. The most recent quarter showed approximately $11 billion in revenue, which is a great sign toward that end. Earnings per share grew from $3.38 to $4.10 adjusted over this 10-year period, which is a compound annual growth rate of 2.2%. It's the same story as revenue here, one of disappointment, but also understanding. It's ultimately where the business is going that matters most, and we may have very good news on that front. Looking forward, CFRA believes that Magna will compound its earnings per share at a 10% annual rate over the next 3 years. This looks realistic to me. It's pretty much in line with what Magna was doing before the pandemic hit. There are signs that a bottom has already formed, and it looks like the upswing is upon us. Magna's Q2 report, its most recent, showed an 81% year-over-year increase in adjusted earnings per share. This upswing could be coming at just the right moment, in time for what may be a secular tailwind. CFRA speaks on this, and I quote, "We also view Magna as a winner from the secular growth of EVs and AV technologies over the next decade, and expect its power and vision and complete vehicles segments to grow faster than other segments as a result," unquote. If the future is more electric vehicles and or autonomous vehicles, which seems to be where we're headed, that almost certainly translates into more reliance on the likes of Magna. I wouldn't assume double-digit dividend growth from Magna over the next few years, even if double-digit EPS growth materializes. The business is still licking some wounds. but even a high single-digit dividend growth rate would be enough to support a pretty compelling investment case as you're starting off with a fairly juicy yield of over 3%. And it's quite possible, due to the tailwinds that I just pointed out, that Magna does deliver something closer to a double-digit dividend growth rate when looking out beyond the next few years. That would be getting things back to what Magna was delivering on earlier on in the decade. Not a bad setup at all. Moving over to the balance sheet, Magna has a very good financial position. The long-term debt-to-equity ratio is 0.2, while the interest coverage ratio is nearly 11. I'll note that cash offsets almost half of all long-term debt, and long-term debt has been heading lower since peaking in fiscal year 2020. Profitability is adequate, but I see some room for improvement. Net margin has averaged 3.5% over the last 5 years, while return on equity has averaged 12.1%. These numbers have both been negatively affected by pandemic-related issues that have plagued the industry. Returns on capital were much higher than this before fiscal year 2020, and I don't see why Magna can't get back to where it was before, possibly even beyond that level. Magna is a good business even in the middle of a storm, and it's quite possible that it becomes a great business on the back of industry trends that play to its strengths. And with economies of scale, barriers to entry, and switching costs, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Recent quarters have been impacted by exposure to Russia, and that situation has not gotten any better. Input costs are highly volatile. Magna has customer concentration risk. Its 6 largest customers account for nearly 80% of annual sales. Demand for auto manufacturing is tied to macroeconomic factors that are beyond Magna's control. Their direct exposure to economic cycles is amplified by the capital-intensive business model. Kinks in the global supply chain are unwinding, but this remains an ongoing challenge. Constant technological changes in mobility introduce the risk of Magna being left behind. The company's international footprint exposes it to geopolitical risks and currency exchange rates. These risks are fairly standard for this type of business model, but the business itself strikes me as anything but standard, and with the stock down by almost 50% from its 2021 peak, the valuation also strikes me as anything but standard. The price-earnings ratio is sitting at 13.6 based on trailing 12 months adjusted earnings per share. That's well below the broader market's earnings multiple. It's also favorable in comparison to its own 5-year average of 18. The price-to-sales ratio of 0.4 is slightly lower than its own 5-year average of 0.5, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. Magna's demonstrated dividend growth over the last decade has been generally quite a bit higher than this, and the near-term forecast for EPS growth would support double-digit dividend growth over the coming years. Moreover, the payout ratio isn't very high. However, I'm balancing all of that against the fact that recent dividend increases have been in the mid-single-digit range. In addition, the industry does not seem to be fully normalized yet. Magna could surprise me to the upside here and get back to its historical dividend growth rate soon, but I think it's prudent to err on the side of caution. The dividend discount model analysis gives me a fair value of $65.63. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates MGA as a 3-star stock with a fair value estimate of $71. CFRA rates MGA as a 3-star hold with a 12-month target price of $65. I came out to within pennies of where CFRA is at, but we're all pretty close to one another here. Averaging the 3 numbers out gives us a final valuation of $67.21, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. Magna International Inc. is perfectly positioned to capture incrementally more business from the increasing pervasiveness and complexity of mobility. With a market-beating yield, a double-digit long-term dividend growth rate, a moderate payout ratio, nearly 15 consecutive years of dividend increases, and the potential that shares are 12% undervalued, long-term dividend growth investors looking to profit from the rise of EVs and AVs ought to have their eyes on this name. And now for a special news announcement. Novo Nordisk AS, stock ticker NVO, just reported a blockbuster first half for 2023. Net sales climbed by 29% year over year. Earnings per share grew by 44% year over year. Astounding numbers. This company is set for a multi-year run on the back of its very popular diabetes and weight loss drugs. If you don't yet have this long-term winner in your portfolio, that's something to reconsider. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.